Hello and welcome to Commodity Culture, where we break down the commodity space for both new and experienced investors. Before we get started, standard disclaimer, none of this is investing advice. Do your own due diligence. And today I'm very excited to welcome to the show Gwen Preston of the Resource Maven. Thank you very much for joining us today.
Thank you so much for inviting me to be here.
So I want to get started like I do with all new guests with the origin story. So how
Mm.
did you start your journey in investing and what eventually led you to the commodity space?
In what is perhaps not an unusual story these days, it was not direct. My background is I have a bachelor's degree in chemistry, analytical chemistry. Then I have a master's degree in journalism. And I did that combination because I love teaching and explaining science-based concepts. And so I wanted to be sort of a science journalist. I didn't think there were enough journalists out there with enough of a technical background to deal with the data that needs to be discussed. And then, the realities of conventional journalism reared up. And I was like, oh, I don't really want to work split shifts at a newspaper for a decade covering break-ins at the 7-Eleven before I get a chance to do what I'm trying to do. So So I ended up answering a job offer at the Northern Miner, which is a very long established newspaper all about global mineral exploration and development. And I knew nothing about mining at that point. And interestingly enough, I also knew nothing about investing. I used to read the newspaper. My family is a big newspaper family. I used to read the newspaper from cover to cover every day, except the business section. I would get rid of that. I didn't want that thing. So I knew nothing about the stock markets, nothing about investing, nothing about commodities. But it was an incredible place to learn, right? So the Northern Miner covers everything from what's going on with commodities to what juniors are doing to what majors are doing and financings and the whole meal deal. And you write about it from an unbiased perspective. You're not allowed to own stocks because you're a journalist. So I was able to learn a huge amount and see other people learn lessons of investing for 5-6 years and travel the world, see projects, meet people. It was a very amazing experience. In the middle of that, I actually spent 2 years away at a different job. I was a ghost writer for Marin Katuza, actually, at KC Research. So that introduced me to the newsletter side of things and to an energy side of things. Anyways, and then in 2014, I just decided that it was time for me to start investing. I had been watching and learning, and I decided markets were at a bottom, and if I was going to get started, this was the time to do it. So even though I knew I didn't know everything that I wanted to, the only way to figure out what you don't know is to try, right? So I quit my job and started my own newsletter, and that was back in 2014. And the years since then, I've learned even more than I did in those first few years. So it's been a great ride.
I want to touch on a tweet that you made fairly recently where you said one investment opportunity is clear once we're through this storm. Metals. From copper and silver to uranium, demand is going through the roof as supplies fall. Could you expand on that a little bit and explain what are the catalysts that make you so bullish on the metals?
For sure. I mean, this is as junior mining investors, we love to focus on the near term, right? We're looking for the stock that's going to shoot to the moon tomorrow. But as commodity investors, I think it's important to have a longer term horizon, not long term, but at least a medium term horizon. There's no point investing in any of these stocks unless the macro setup is bullish, right? And so I've spent a lot of time through these last few years when things have been so up and down and left and right and, hard to predict, thinking about the macro setup. And the theme that comes from that most clearly, I think, is how the greening of the world, the trend, the paradigm shift in how we do almost everything that we do in the world, is creating demand for metals that far exceeds our current ability to supply those metals. And the reason that there hasn't been a supply response to that is pretty interesting, actually. So if you go back to the last time we had a huge surge in metals demand, that was the emergence of China in the 2000s. And as it became clear that this China growth story was a real thing, supply responded almost in lockstep. And so, in 2004, 2005, 2006, those were great years for commodities, but there wasn't this looming huge dearth of supply because producers were like, okay, we need to start producing more. And they had investor support and they had permitting ability, and they had management interest in developing new mines. All three of those things are missing today. Investors are not interested in commodities in particular. There's been far too many other interesting and profitable arenas in the stock market over the last few years. So investor interest isn't there. Management is hesitant. I think they're getting a little bit more, very slowly getting a little bit more aggressive, but the lessons of the last bull market are still very much with management who were not the management who made the mistakes of the last bull market and screwed everything up for commodities investors. So they have been very focused on dividends and free cash flow and share buybacks and not on growth. And then the permitting factor is a very real one as well. Back in that China growth phase, you could probably permit a feasibility stage mine in a few years, right? That's just the way that permitting worked around the world back then. Now, if you have a feasibility stage mine and you want to start permitting, it's going to take you 5 years at the least, and maybe several multiples of that. So there's actually a real barrier to creating new supply response, especially because management teams have been dragging their feet and investors haven't been interested, so they haven't bothered starting the process in a lot of cases. So the supply response isn't there. And what that means for a lot of metals, and copper is sort of the very, very clear example here, is that we're pushing towards this point where we just don't have enough copper, and the market trades as a very day-to-day market. You know, the copper market likes to respond to a strike at a mine in Chile pushing the copper price up, or comments from Chinese politicians about a new stimulus program or the lack of a stimulus program in the next little while, and those will move the copper price today. And that's fine, because that has to do with copper availability over the next 3 months. But what's frustrating to me as a metals investor is that what matters is copper availability 2 and 3 years down the road, when it isn't. But I actually think we're going to have to get pretty close to that. And the situation is going to have to become blatantly dire. And then all of a sudden, this is going to go crazy, because you just can't function. You can't grow the world in a non-green or in a green way without this amount of copper. And the green way is the way that's happening. And so the needs are very, very dramatic. Then you look at things like lithium. I mean, lithium was a nothing market. Lithium was literally used for almost nothing 15 years ago, right? Before batteries became so important. It had a few uses, but it was a tiny, tiny market. Now it has to grow 20-fold or more in the next decade. The growth numbers, very hard to wrap your head around. The market hasn't been interested in wrapping its head around it. Metals still trade as a very moment-to-moment thing and not as a forward-looking thing. And so it's sort of developing into a storm that will not manifest tomorrow, but when it does, I think the manifestation is going to be pretty dramatic. I think the price moves here are going to be quite dramatic. So that's why especially since markets have been so hard to predict and operate on a short-term basis of late in the metals space, I certainly have been focusing on the medium term, and I'm just positioning for that opportunity as it emerges.
Okay, I want to touch specifically on some of those individual metals you talked about in that original tweet, and we'll start with copper. I had Lobo Tigre on the show not too long ago, and he said that for the decade ahead, hands down, no question, copper is the commodity he's most bullish on. Do you agree with that sentiment? And do you think the situation you've described is going to eventually lead to a reduction in permitting times and ESG mandates? Is that something, is there a reckoning coming for that system eventually?
I think that's a pretty astute question. I mean, there's obviously a very important balance here. Permitting has become longer and longer because people are very interested in what happens in their environments. And that's important. I'm not trying to downplay that in the slightest. But the need to permit new mines is also very important for growth and for prosperity and for all of these things. And for the green revolution. And so, yes, I think there will be some bit of a reckoning. I think one maybe parallel here, same but different, is in the uranium space right now, where there's long been talk in the United States about how they're reliant on Russian uranium and how that this is a national security issue and it doesn't work and we need to make domestic uranium, but there hasn't actually been any political moves to do anything about that until it became much more dire, until, you know, of some of the evolutions in the US-Russian relationship over the last few years. And then, of course, Russia's invasion of Ukraine really like tipped the scales. And now all of a sudden, the US is soliciting bids. They want to physically buy uranium. They want to set up contracts with uranium producers. I wouldn't be surprised if to see, you know, some specific plans to speed up permitting in the uranium space. So I think uranium is maybe leading that curve a bit. So I do think that there will be some expediting of permitting. Maybe it's just, and they won't frame it as expediting of permitting, but it'll be more resources applied to try and make these things happen faster, because it's just a necessity. So yes, I do think that will happen. And I agree with Lobo that, especially in terms of a low risk bet, some of the other markets where the demand profile is so dramatic are smaller, and smaller markets are always more volatile, like lithium, like uranium. They're always going to be more volatile. Copper is a massive market, right? And sure, it's got some volatility, every market does, but I do think that if you're looking for sort of a low risk, this is going to happen sort of bet that couldn't be more plainly painted, then I agree for sure with Lobo that copper is where it is that bet.
Let's move on to silver now, one of my favorite commodities. You know, we're set to see potentially big industrial demands. Silver is already hugely used for industry, which a lot of people don't realize how many things actually need silver. But it also has thousands of years of history as a monetary metal. So it's got both the industrial component as well as the monetary component. But these days, the prices of silver, when at least put in fiat dollars, have underperformed a lot of people's expectations. You've got the silver stackers with, you know, just tons and tons of ounces in their basement, and they're just wondering when it's going to go to the moon. What's your overview of the silver market at the moment? And do you see any catalysts that could eventually raise the price here up ahead?
Sure, for sure. Good capture of the background for silver there, for sure. Silver has, you know, we love to talk about leverage in the metals market, and that usually refers to like producers and how much more they can make when prices go up because costs remain relatively stable, and that's why, you know, stocks outperform the metal, and then it cuts the same way on the downside. Silver sort of has that leverage in a bit of a different way, which maybe I'm stretching this analogy a bit, but when interest in precious metals as an investment is weak, silver sort of gets double that. Like, it's sort of gold hurts and silver hurts extra. And that's what we've been experiencing in the last little while, for sure. I mean, gold has been fine, for sure. Silver has slid more, and it has underperformed, like you said. So I feel like silver gets hit harder on the investment side, on the investment disinterest side. But then its saving grace for sure is the industrial side. And that is where my bullishness really sits with silver. And you likely have heard this layout before in some form, but there's lots of different uses of silver, but certainly solar panels are one of the most important ones, and most important in terms of growth. What I like to lay out is that currently solar panels take about 10% of silver. The International Energy Association's projection for how many solar panels we're going to need to meet all of the various goals for green energy and whatnot would require us to increase solar energy almost tenfold. So that alone suggests that solar panels would take up all of silver demand in the next, whatever the time frame is. I think it's 10 years, it might be 15 years. It's that ballpark. Okay, so that's pretty bullish on its own, because obviously silver can't take, or solar panels can't take all the silver. There's still other things that need silver. But the thing that tips this one really over is that China is by far the leader in solar panel technology, and the Chinese have been increasing the silver load in their solar panels significantly of late, like doubling or tripling the amount of silver that goes into a solar panel. And they do that because it pays, right? The increased efficiency from the increased silver loading is worth it. And so then all of a sudden you have silver needing 200 or 300 of the amount of solar panels needing 200 or 300% of the amount of silver that's produced, that is a supply gap that's pretty dramatic, right? So that's where, again, we're in a moment in the market right now where people are not particularly forward looking. I said that they're not forward looking for metals in general. They're not particularly, they're sort of especially not forward looking for anything right now, because we're in this inflation, tightening, recession question mark phase. And so fine, nothing's working right now in the metal space, and that's okay. Once we get through this moment, however we get through it, whether there's a recession or not, I don't know the answers. That would be another whole conversation. I do think that some of these realities around the copper market and around the silver market, I just think that they have to come to the fore. And that's why I made that tweet about how I just think it's really a very obvious opportunity. There's other considerations out there about what investors are interested in thematically after we get through this moment in time. That's another important factor, very difficult to answer as well. But even sort of regardless of that factor, metals just have to be worth more. There's just no question about it.
So let's talk about gold as well then. A lot of people, once again, have not been very excited with its performance. You know, I posed this question to Jim Rogers and he was almost upset with it. He said, "Don't you know that gold just hit an all-time high recently? What are you talking about?" And I said, "Yes, I'm aware of that, but you know, it's not there anymore." And a lot of people thought that in the face of geopolitical turmoil, in the face of, the Fed just printing money, in the face of, record inflation, a potential recession looming on the horizon, or we're already in one, who knows, um, that gold would perform more dramatically to the upside. So what's your view on gold right now, and where do you see that market developing moving ahead?
Yeah, gold is a very interesting space right now. I mean, I've been writing about gold and projecting what gold is going to do for almost a decade now. And it is the hardest right now to predict, I think, than it has ever been in that last decade. And there's a couple key things that feed into that. So one of the big ones I mentioned a moment ago about sort of thematically what investors are interested in. I think gold more historically, sort of certainly before COVID, probably before the Great Financial Crisis, because the Great Financial Crisis was the change in how monetary policy affected the markets, right? All of a sudden we had central banks being very active and aggressive in the stock market, in the bond market, in trying to support these things. And that created an investor that paid a lot of attention to interest rates. So it really changed sort of the way that investors approached investment opportunity. And one of the big things that it did is that the Fed sent this message that we will backstop risk. And sure, the Fed's mandate is not actually to support the stock market, but that's what they had until perhaps more recently. We'll see if this is a different moment. But through the Great Financial Crisis and in the COVID crash, very clearly, they stepped in and backstopped risk, right? They basically said, we're not going to let the stock market fail because it's too big to fail. The tailspin effect of that would be too big. By doing that, they sent all kinds of speculative things to the moon, right? Monkey NFTs and all manner of things traded, all manner of incredibly speculative things traded, generated huge profits for investors. The reason that I say that in response to a question about gold is that gold stocks used to be one of the only reliable spaces that provided that kind of speculative return. When gold was rising, gold stocks provided good opportunity to get very strong returns in a very speculative market, right? It's still exploration, you still don't know, but gold stocks did that, and they have for years. And they still will, except that now they had so much competition. And so people were like, well, why am I going to buy gold stocks when I can buy monkey NFTs and they just go up every day? And so there was a huge, so all of that backstopping of risk pulled speculative interest to other parts of the market. And I don't think that had happened in such a dramatic way before, especially in such a short time frame with the actions of the central bank. So I think that pulled interest away from gold stocks. Similarly, it pulled it away from gold. There were just too many other things that were doing well. And so all of the classic arguments about why gold should move in what direction when, about real interest rates primarily, and about economic growth and all of these things, they still worked, but their impacts, but the movements in the gold price were diluted. They were just minimized because investor interest wasn't there to the same extent. And so that brings me back to what I said earlier, which is I really think one of the key questions today is, what are investors going to be interested in when we come out the other side of this moment? This tightening, inflation, central banks, are they going to fight the stock market? Like, what are they going to be interested in out the other side of this? Is there still going to be this concept that the Federal Reserve is going to backstop risk, in which case we'll sort of return to where we were post-COVID, or at least post-great financial crisis, that sort of speculative gold is not, interest in gold is diluted environment? Or will we return to a more conventional classic setup where the central bank is focused truly on inflation and unemployment and not on supporting the stock market? And then the message might go through, well, they're not going to support speculative stocks for the sake of doing so. And then if we return to a more conventional space, then maybe interest in gold and those patterns that we used to rely on would come to the fore a bit more. All of that said, I mean, you can always point to sort of other big themes that support gold. Geopolitical tensions are obviously a big one. The rise of China was a story that I would have talked about dramatically, even a year ago now. It's diluted a bit because China is obviously going through some of its own economic struggles. Gold is going to do fine. I mean, the chart of gold, the 100-year chart of gold goes up, right? Because that's what gold's role is. We as investors want it to go up dramatically in a short time. That part of, whether that's going to happen is hard to know with gold these days, because I think there's just too many questions around inflation, recession, and investor interest to really know. I think it's going to hold its ground, but I can't really say more than that in the short term.
So I want to talk about uranium now. It's my favorite commodity of all time. So when it comes to the fundamentals, to the thesis, we've discussed it so much on this show that we don't really need to get into it. But I am curious how you approach the space. Do you prefer explorers, developers, the big producers like Cameco and Kazatomprom, ETFs? What are you looking at in the sector right now?
Cool, good question. So I personally am spread across everything that you said. And the reason that I am, like, there's a sort of clear rationale behind that. I love exploration. I have expertise in exploration. So therefore I have a higher likelihood of choosing explorers that outperform. So that's great. I certainly want to put some eggs in those baskets. And so I have a few stocks that I do think have good odds of generating exploration results this summer that will be standout. And especially in a market that's as small as uranium, there's so few, really active explorers. I think, those will get very rewarded. But the uranium market went through such a bear phase, right? Like, it really just those years just squeezed the life out of the uranium equity space. And it took the number of stocks that trade from 500 down to 70 or something. So kind of due diligence has somewhat been done for you. And which is to say that most stocks out there that are doing something around uranium have some validity to them. I don't want to say that every junior that just debuted with uranium focus is a good pick, but those who have survived the bear market and continue to be active, they likely are valid explorers, pre-producers, whatever it might be, because you just don't survive a decade of terrible markets if you don't have some robustness to you. Okay, so that matters. And then there's just the scale of this space. When investors as a whole turn their interest to uranium, the results are very dramatic because the space is so small, right? If there's only 70, that may even be an optimistic number, stocks, things that you can put your money into, then it's just trying to shove Niagara Falls through a garden hose, right? Like, the pressure becomes very dramatic. And it's helped in the last few years that we've had some big liquid players debut, obviously, like the Sprott Physical Uranium Trust matters, Sprott taking over URNM and turning that into a bigger, sort of more dynamic vehicle. Those things matter because those can help with the liquidity thing that I just described. But nonetheless, when interest turns to uranium, the rising tide effect is amplified because the space is just so small. And so that's why there's no, while an exploration success can really catapult and obviously make it worth making some of those exploration bets, exploration is a hard and risky, unreliable thing. And so I'm not going to put all my eggs in unreliable things when I am so convinced that uranium as a whole is going to go on a run. And when that happens, the entire space is going to run. So I am spread across the space. That said, I do prefer equities over the price. So I would have more, as a low risk investor, I would put more in URNM, the fund that's primarily uranium equities. It still has exposure to physical, but anyways, primarily uranium equities over the Sprott Physical Uranium Trust because of just leverage. That's just a leverage decision, and I don't think that the risk difference is that significant. But I really am spread across because of the confidence that I have that this whole space is going to go, and when it goes, uranium goes crazy, and so I don't need to lean just into exploration stories.
So you've mentioned on Twitter as well that timing matters when investing in the commodities space, but we know that market timing in terms of finding the bottom and knowing when to sell at the top is kind of a losing battle. So how do you gauge when might be the right time to deploy capital into a sector, and how can investors in commodities know when might be the right time to buy?
Ah, you just need a really good crystal ball. My daughter, who's 4, she's got several. I consult with them. No, I'm kidding. Um, so this is not about picking tops and bottoms, right? This is about understanding macro forces. And so and there's layers of macro forces, right? We talked a lot at the beginning of this conversation about the incredibly bullish supply demand fundamentals for copper. And yet in the last, we've had some periods of significant copper weakness this year. So it's not that simple. You have to take the metal fundamentals, and then you got to take the rest of the investing macroeconomic world in stride. And so, like, right now is a good example, very bullish on metals, but I don't think that investors, well, 6 weeks ago, I didn't think investors were interested in growth as a concept at all, because Google searches for recession were like at an all-time high. That has transitioned even in the last 6 weeks. There's more and more people, I still not a majority, I don't think, but there's more and more people who don't think that we're going to have any kind of serious recession. The jury is still very much out on that question, but growth is just on the periphery of the conversation at this point, right? We still have huge questions about what's going to happen in China. Chinese growth is always a very important factor in global growth. And then understanding how the rest of the Federal Reserve tightening phase is going to impact inflation, how quickly it's going to impact, what that's going to do to growth, what that's going to do to jobs. These questions are still at the fore. And so until those simmer down a little and growth starts to come into the conversation, people will not, in general, buy growth stocks. And metal stocks are growth stocks. That's all they are, right? They're value. And I don't mean growth as in like speculative growth. I mean growth as in like economic growth. They are value stocks based on economic growth. And so, could you buy now? Sure. Is there more downside ahead? Who knows? I am still mostly on the sidelines because I do think that there's risk of more downside ahead. This summer bull run has been quite dramatic, and certainly many people argue not particularly valid. Other people say we're going for it. I don't know the answer to that. At the end of the day, you have to step back and think about your time frame and your goals. Trying to pick the bottom is a losing game, like you say. trying to enter generally near the bottom and ride the general upsurge in a movement, that's the goal. And so do you buy right now? Do you buy in a few months? Did you buy a few months ago? At the end of the day, it probably won't matter. If you're buying uranium, lithium, copper, silver, I don't think it's going to matter in 2 years, whether you bought a few months ago, a few months from now, or today. I really don't think it's going to matter. And so that's what I mean by timing. I certainly don't mean day to day. If when to enter a stock is a source of anxiety for you, that's very common. And so just average in over 6 months. Find a way to ease that anxiety for you with the mind frame that what you're trying to do is enter generally at the bottom. That's my approach to it. And so that's what I'm thinking. I'm still a bit on the sidelines. Maybe I've missed some of the move. I don't know, but it doesn't keep me up at night because I'm thinking about a 2 to 3 year time horizon here. And that's what has me excited.
Well, Gwen, thank you so much for joining us today. This has been an awesome conversation. For those who want to learn more, where can they find the Resource Maven online? And could you let us know a little bit about that?
Absolutely. So my website is resourcemaven.ca. I have several newsletters. The main one is a weekly newsletter about what I'm buying, selling, and thinking in the metals and mining space. And so it's about what I am buying. It's a subscriber supported newsletter. I don't take money from companies for coverage. I'm also with a colleague about to launch evergreen investing. So for those who are lower risk, commodities interested investors, evergreen investing is going to be about a bunch of the things that we just talked about today, the big picture opportunities in these metals and in other things like agri-foods and carbon credits and things like that are coming from this revolution, that I think will, similarly to what we just said, come into play once we get through this weird moment that we're in. So evergreeninvesting.ca, actually that website's, or .com, .ca. That website's not quite live yet, but will be soon. But resourcemaven.ca, that's where my website is. That's where you can find free trials and take a look at what I do. And you can also find my contact information there. I'm always happy to be in touch with interested commodities investors and have a chat.
Great. Well, I'll put links in the description below so people can find those. Thank you so much and hope to have you back on to continue the conversation.
Thank you so much for having me. This was super fun.
Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.